Hello, my name is Rick Leinbach. Thank you for attending our equity crowdfunding series. In today's series, we're going to dive a little bit deep and talk about the equity crowdfunding agreements and look at the sort of behind the scenes a little bit on what happens if you go down the path of equity crowdfunding. Obviously, we do this through examples. So hopefully we'll give you some nice examples as we go through the document. Like I mentioned, equity crowdfunding, it's our June series. You hit that button to get us going. My name is Rick Leinbach. I'm outsourced CFO. Spent the last 30 years working for private and public companies, and hopefully today can give you a little expertise on the equity crowdfunding and some of the agreements, etc. I am part of Startup Portal, and founder of Startup Portal, and we provide outsourced accounting and financial services. And we've based Startup Portal on a cloud platform where you can use today's cloud tools to operate your business. Now, I usually like to start with samples. Here we have Studley Brewing Company. They've raised $48,000 on equity crowdfunding. And equity crowdfunding is utilizing the crowd of friends, families, potential new investors. You have to go through a crowdfunding portal. Here they've raised $48,000 through 37 investors. They're looking for about $70K as a minimum. They're hoping to get $200K as a max. Now, their agreements in equity crowdfunding have different flavors of agreements. Here it's what's called it's debt, but it's on a revenue share basis, meaning that you pay back investors based on a percentage of your revenue that you're trying to raise, or future revenue. So what we're going to do with Studley is just drill in to the actual agreement itself. I'll take you in there and see if we can look at the document. With the SEC, you have to file what's called a Form C, which is the initial kickoff of the agreement, and it really provides that legalese to allow you to register the securities, and they're all securities in all of the states. So it was basically formed from the Jobs Act, started in 2012, really been around since 2015 or 16. But here in the Form C agreement, the company tells their story. This is Mainvest as the offering portal. And essentially, I'm going to walk you through the document where you have the offer memorandum. You basically have the legalese of telling the story about the Schedule C and what is it, and then defining the company's information, the owners who founded it, just to make sure that you get an understanding that someone who is coming into the brewing industry has experience. They may not be a brewer, but at least have the experience that relates to their business. It allows you, to as an investor, allows the investor to look and make that decision. And the entrepreneur has provided their details to say, hey, here I am. This is why I want you to invest in me. Now, the Form C and behind it is a legal document, usually kind of straightforward, simple. The actual websites that are on the equity portal really have I'm going to say the sexy story, but it has a story and a video and all of that. Here it's really that legal side to make sure that the entrepreneurs are covered. You go down and they'll talk about who owns the company and what they've been doing, their brewing experience here. This has been a home brewer for 6 years, and then essentially graduated from there and other expertise in brewing, and now ready to get on their own. And then it take you through some of the risk of investing. The risk and uncertainty is that you could lose money. So in fairness, the investor knows that coming in, and the entrepreneur says, hey, take a risk with me. Here, like I said, they're looking for a minimum of $70K, and their target deadline is July 15th, 2022, to close it out. So what happens is you kind of set a window to say, hey, we're going out to the public, friends and family, invest with us, and then it comes back to shutting it down and seeing what proceeds are there. And that's important. They give the story here, as you can tell, of having 70,000 as a minimum and why they need 70. And if they were able to raise 200K, the maximum, what they would do with it. Here it would be the build out of the facility. Let's say they raised the 200K, it might help them avoid adding additional debts to the business or something of that nature. And then you get into some of the risk uncertainties I mentioned. I'm talking about the price of the securities, and then I will get into the payback. This is a revenue share. So if you hit certain marks, they're going to pay back for anywhere from 2% to 5.7%. And early investors, sort of getting people excited in the crowd, they get a return of 1.6% of their investment. As of today, if you invest, you get 1.4%. You put in $100, you get paid back $140. Now, when you're looking at this, they have 5 years to do it. So really what you want to do is say, okay, how much do I believe in them? And as an entrepreneur or someone looking to have people invest in them, you want to give them the story that you're able to pay them back on a pretty timely basis. In that case, shortens that period of time, they get their money back, and they start getting their money back right away, and the return is can be pretty good. The nice sort of fallback is you do have a 5-year period if you're the company that's raising money. And here you can see the scale. If they raise $200K, they're gonna pay back 5.7% of their revenue. Where they stand now, they're still at the 2% level. So again, one of those things that the more the crowd participates, the faster the crowd gets their money back. I like this type of scenario just for the fact that you're getting your money back based on revenue. And then we'll go down and we'll see that they actually project at a budget. Typically, Mainvest companies provide a budget that shows, hey, we think we're gonna achieve over $1 million a year for 5 years straight. So you could, in your own model or numbers, you could discount it if you're an investor and say, hey, if they can do 80% of that in 3 years, I think I'll get my return back. And really, the incentive actually having it from 1.6 versus 1.4 hopefully allows people to say, hey, wait a second, I'm going to get a pretty decent return based on these numbers and get people excited about it. Now, I know this is dry legalese paperwork, but it helps tell the story. And for me, I can read in and go through the documents, seen enough of them. For the investors themselves, they actually go back and jump into the website at Mainvest, and this is where they see the story and may see a video and tell the story about the company. Here they're looking for the investment, 1.4 right now, and that's 22 days left. Investors get you provide the data to them, what you're going to do with the funds. Again, here's a graphs, a little easier to absorb visually and really tell the story. And it goes into more and more data, provide you the detail and the documents of the company as we just looked at, and then go through and again, in probably more of a summary basis, explain and tell the story to hopefully have investors come in and be part of their story and help the company actually expand and technically grow with it. So we'll get down into more of the details, but obviously you can go to Mainvest as or any of the portals and look at the current deals that are out there. Now, so that's a long-winded example, but diving in, as I mentioned earlier, to the behind the scenes of what's being put together. Now, Fans Own Club, and I won't go into that much detail. These guys, this is their second crowdfunding. Currently, they've raised $71,000. They're looking for about $700,000. Here, as I mentioned a window in the last one, July it closed. Here they have a pretty long runway of 313 days to raise capital. The one thing about equity crowdfunding, you do have up to 12 months to raise $5 million under equity crowdfunding, CF version, in a 12-month period of time. So they're taking that extension and basically, I want to say, taking the long road show, but asking people to participate and be part of their Austrian soccer club, so you can own part of it. They did the previous crowdfunding raise where they raised $324,000. They do have a valuation, and we'll talk about valuations in a little bit, but they have a valuation of $28.1 million. I don't know what the value of an Australian soccer club is, but if you look at some of the other ones, it may be actually low. So I really just have to do the study and say, hey, is that worthwhile? And do I want to be part of it? So those examples really give you a sense of the traditional way of raising capital, private equity, banks, individuals. Equity crowdfunding changes to sort of the crowd as your private equity, and having the ability to have different portals and funds and way to do different deals allows you to really be creative and see how creative people have already been in putting together deals to raise money for your company. There are 60 plus portals. I would say that the top 10 have the most activity, and the other portals are coming along, maybe have different business models, maybe have real estate like Equity Door. So there's a variety of equity crowdfunding portals to look at and see what fits your business model. As I mentioned, you can raise up to $5 million in a 12-month period. The next level of equity crowdfunding is Reg A. You can raise up to $75 million in a 12-month period. We actually have seen public companies come back and do a Reg A because the burden of compliance is a little easier with that. It is regulated by FINRA. If you've never heard of FINRA, they regulate broker-dealers and stockbrokers. So in essence, the portals are like a broker-dealer, or and manage the platform and have to go through that vetting process that actually hopefully protects the investors as well as the people raising capital. The types of agreement, we saw two types: revenue share, just sort of debt, and then common investment ownership of your company, or excuse me, of the football team here in the U.S. soccer team. So, but you can see there's different ways to put deals together and shape the deals to allow you to say, hey, does this fit for me? It's not for everybody. It really takes the evaluation of, when I'm raising capital, how much do I need? And just making sure you leave yourself enough runway, and we'll see an example in a minute, leave yourself enough runway that allows you to execute on your plan. So that's half the battle in itself. Now, the activity is significant, even on a monthly basis. I brought this up last week. I shared it again with just looking at May 2022. We'll have June once the month's over. But the deals have pretty high valuations in certain instances. Like technology typically has high valuations. Other aspects of restaurants and bars may have a different valuation, or transportation. It just depends on the type of company it is, and if they're using technology, if they're scalable, and in some respects how they value themselves. So it's one of those things that you'd be cognizant of, the fact that you don't want to overvalue yourself, you don't want to undervalue. So it is a balancing act, no doubt. Now let's look at another example. Alpine X. They are trying to have snow sports resorts around the country. They have raised $1.3 million, 1,500 investors. They're looking for up to $5 million, again, that cap, in a 12-month period of time. And they're value themselves at $40 million. This one, in this respect, is a stock purchase deal under the Republic Group. And essentially, digging behind the scenes with the stock purchase agreement, you actually have a subscription agreement where it details sort of the terms and conditions of the agreement, what ownership you would have, usually sets the date of when the agreement will be basically complete, and then getting into the details behind it. And obviously with any of this stuff, there's always that no guarantee, sort of that coverage to say, look, this is a risky investment, and there's no guaranteed return. This is not uncommon from any investment, but it's clear in all these agreements that you have to have it in there to protect everybody. Now, last example I have here is Hit Check, and they're essentially helping athletes who are getting hit on a daily basis. So it's a cool technology, no doubt about it. They're looking to raise $2 million. To date, they've raised $74,000. Essentially, they have a valuation of $12 million. And obviously, for them, that valuation is part of the equation in the balancing act, right? So their offering itself is 18,000 shares, at 53 cents a share, which is the $2 million is sort of the max that they're looking for. So the valuation of the company, they've said, is $12 million. So what happens is you look at the pre and the post valuation. Here, as you look on the chart to the right, had they invested all the money, they would have 14%. They, being the new investors, would own 14% of the post-value company. Now, when you look at post-value, what it really means is that value we've set before we took the cash in, and then essentially the instant after we get all the cash in is really the post-value at that point in time. Typically, what happens is you're going to take that cash or capital and invest it in the company to hopefully grow the value at a future date. So your next pre-money valuation, if you need additional money, but your next pre-money valuation could be, say, $20 million or $25 million. So the goal is to take that $2 million and invest it, for the company for the future. Now, in this case, they're only at 3.6% of the max $2 million right now, but it does leave 96.4% as of today, allow them to essentially do one or two things. One, they could pull back and close this offering and say, you know what, maybe it wasn't a fit, it wasn't the right time. But they do have the year to come back and go to another platform or come back on this platform and redo the offering. So obviously there's some legalese around it, but you do have the ability to allow you to be flexible with it, especially after you've put all the effort in going through and putting the legal documents together, the marketing videos, really telling your story and doing press releases and getting it out there. But it happens. And obviously plan, but unlike public IPOs, where the market goes down and all of a sudden people pull back on their IPOs. It just happens, and there's flexibility designed into equity crowdfunding. So lots of examples. The ups and downs, pluses and minuses this week of crowdfunding. The various portals allow you to fit your business, no doubt about it. The process is established. It is still young, but there are many deals that are out there, certainly for you to look at and do comparisons to see, hey, does that fit for me? There are the legal protections for the entrepreneurs, just like private placements with Reg D, just like public entity. So the legal aspect is certainly in place, and the deal structures. There's flexibility to allow you to put your deal together and fit your business model. So now downsides, it's a bit complicated, no doubt about it. However, having those experts help you in that process. The pre and post money valuations, can be unfair. So just, it's not a perfect science, no doubt about it. Certainly, each company has its own vision of itself and its own valuation, and trying to pick up and pull in investor capital is a tricky business. There's SEC reporting, for 3 years afterwards, where you just tell your investors what you've done with the funds, or hopefully show them the progress you've made, or you may need additional financing that'll show them that as well. Obviously, there's no guarantee. As we saw from the last company, they wanted to raise up to $2 million, and they've raised $74,000. So certainly, there's no guarantee. And with investors, they're putting their funds as a risk, so there's no guarantee there. And then the other aspect is just, lastly, the ROI for investors. They do want to know, hey, what is my return? I was able to kind of give you a sense on the rev share of what expectation you could get your money back and get a return, where it could be anywhere from 5 to 30% return, let's say. The other companies where you're investing in common stock, the valuations may be higher, but the future and the valuation and the exit is a little more complicated. So it really depends on the type of company and the structure you're trying to put in place when you're doing equity crowdfunding. So hopefully, these few minutes of going through examples and digging in a little bit provide you a sense of what we're trying to do and educate people with equity crowdfunding. At Startup Portal, feel free to reach out. We provide a variety of services. We have 2 locations in Maryland, but we obviously work with companies all around the country. Next week is our final crowdfunding seminar. We'll work on a July series as well, potentially in financial projections, But certainly, in the chat, give us some ideas. We'd love to expand upon it and really provide what information people are looking for. And then obviously, as I mentioned, this is being recorded. So please leave your questions in the chat, and we'll be glad to get back to you. Or you can email us at Startup Portal, info@Startup Portal, or call us up, look on our website, and we gladly will, try to answer your questions the best we can. So I hope the seminar today was educational and provide you a sense of the ability of equity crowdfunding to be a tool in your tool belt. As I mentioned, it's not for everyone, but when you go through evaluation of your financials, you can see your needs and lay it out, just like the brewery did when expanding their business. Lay out your needs, see the capital there, potentially the working capital you need, as well as looking at your business itself to make sure you have profitable margins to either pay back the rev share or actually bring a return to your investors. So all of these kind of go hand in hand. So thanks for attending, and look forward to educating you in the future. Have a good day.